Welcome, ladies and gentlemen, to another episode of Property Corner. I'm your host, Zaid, here at New Way Real Estate. Today's episode is going to be about return on investment. But today's perspective is different. The other day, I was talking to one of my investors. I sent him an investment opportunity. It was a studio, $370,000. It's generating $30,000 in rent. I was like, hey, listen, it's $30,000 divided by $370. That's around 8 to 9% return on investment. That sounds like a great deal. His response was, that's not the real return on investment. First of all, if I'm going to take it as a bank mortgage, that won't apply. And at the same time, real life investments have a lot more costs that are included in it. So that got me thinking, and I did my research, talked to a lot of accountants, and went through and created an Excel template to calculate the return on investment when you are having a bank mortgage or a bank loan. Now let's move on to the Excel sheet, and we'll walk it through together. So this is a template that I've done in Excel for us to base our example on. We start off with the property details, the property name. In this case, we are doing a furnished studio in JVC. The number of bedrooms, in this case, it's a studio. The size in square feet for this example is 460 square feet. The service charge per square feet in this building is 15 dirhams. We come to the investment part of our example. First, we start with the property purchase price. In this case, this property is listed at 370,000 dirhams. We need to account for all the costs that we will be incurring in the initial part of this investment, such as the Dubai Land Department fees, which is 4%, and the agent commission, which is 2%. To calculate these, we just type in equals. We select the property purchase price field. We fix that by pressing F4 and multiplying it by the percentage. Now, if you're wondering what's happening here, I'm using the formula text function in order to display the formulas while I type them in. The agent commission, we just drag it down. Voila. The next charges or costs are DLD registration charges. These are the payments or the charges that we'll be paying at the trustee office. So it ranges up to 5,000 dirhams. The bank loan or finance registration charges, these are the charges that you have to pay to process the loan and to assess the property, and you pay these towards the bank. So it differs from one bank to another, but let's top it up at 15,000. Rehab costs, these are the costs that you will have to pay in order to fix up the place right after buying it, like for example a fresh coat of paint or cleaning service. So let's put it at 1,500 dirhams. For any other costs that you come up with, this is an open field. In this case, let's say 0. The total investment will be the sum of all the above. To do that, we just type Alt equals. Now the total investment you'll be doing is around 413,700. Now, to know how much of our own money we will be putting down initially in this investment, we have to look at the advance payment that the bank will be asking for before they give us the mortgage. So on average, the advance payments are between 20 to 30%. So let's consider 20% down payment. To calculate that, we just put equals. We click on the property purchase price multiplied by the percentage. Now, when we want to know the total initial invested equity, we have to calculate to add up the advance payment along with all the costs that we have mentioned above here. So to do that, we go for equals sum, highlight all the costs, and then plus the advance payment. With this, we know how much of our own money we will be putting initially into this investment. Next, we have to find out what the bank will be financing for us and how much we will be paying them back per month. To do that, we go to the mortgage value, we type in equals 370,000, which is the property purchase price, minus the advance payment. So the bank will be financing 296,000 dirhams for us. On how many years? Let's say we will consider 25 years. Now, in order to simplify future calculations, we need to know the period, so how many months it will be. To do that, it's equal to 25 years multiplied by 12 months. So it will be on 300 periods. The annual interest rate, right now in the market, the average is around 2.5 to 3%, so let's consider 3%. Now to calculate our mortgage payment per month, we're going to use the PMT function. So type in equals PMT in bracket. The first argument is the rate. In this case, it's 3% annual rate. To make it monthly, we divide it by 12. The next argument is the number of periods. We've already calculated 300. Then you have the present value, which is the total loaned value. The final value, which would be, of course, the bank wants all their money back. It's going to be either 0 or you can keep it blank. The end of period, or the type, which is end of period or beginning, we're going to go with beginning of period. And now you're going to have to pay 1,400 per month. Now it's red because it's a negative amount. Next, we have to calculate the potential revenue that your apartment will be generating. First, we start off with the expected rent. In this case, it was recently rented for 30,000. Your tenants will end up leaving at one point, so you might have the apartment not generating income for a certain period of time. Let's consider 1 month out of 12, so equals 1 divided by 12. Into percentages, 8%. Now to calculate that in money, equals the expected annual rent multiplied by the less reserved vacancy percentage, we get 2,500. Because this is a negative amount, or it's a cost, we must put minus. To calculate the total revenue per year, we just put alt equals the sum of both, we get this figure. Next, let's look at the annual expenses. First of all, we start with the total service charge. We mentioned earlier it was 15. Then to calculate the service charge equals the total square feet area multiplied by the total service charge, you get 6,000. Now this is a negative value as it is a cost. We type minus. The annual maintenance, of course, you can have wear and tear on the apartment, and you have to consider maintaining it every year. So we're going to consider a budget of 1,000 dirhams. Again, minus. Property insurance is mandatory for all the banks to give you the loan on the property, so we'll consider 0.04 equals 0.04 multiplied by the property value, and again this is a cost. Property management, in case you can't handle managing the property yourself, you're going to hire somebody. We usually take 5% equals 5% multiplied by the annual rent. Now this is again a cost. The total expenses you're looking at is equal 9,548 dirhams. Now that we have the revenue and the expenses, we can calculate the annual cash flow. To do that, we go to the annual loan payments equals the mortgage payment per month multiplied by 12 because it's annual. Then we go for the annual revenue, which we have already calculated, equals the total revenue. Then we go to the total expenses, annual expenses, equals the figure here. And the annual cash flow would be equal, the cash flow equals 1,150. It might not sound as much, but let's see the cash on cash return. Just wanted to make sure you're still there. If you are and you're watching this, comment in the comment section below. Keep investing with a thumbs up. We go to the yearly cash flow. So in this next field, we enter equals then select the annual cash flow. The invested equity, which we have calculated earlier, equals the cell over here. Our cash on cash returns will be calculated as follows. We divide the yearly cash flow by the invested equity. We get 0.98%, almost 1%. I know it doesn't sound like much. Maybe you're thinking if you put your money in a savings account or invested into the stock market, you'd have better cash on cash returns or cash flow. Cash return is very important, but you need to understand that we are factoring in the loan payments, the full loan payments. What does that mean? That we are paying not only for interest, but we are paying for from the principal amount. So your principal amount is reducing, which also means that you are gaining equity, you are gaining a property. With every payment, you are closer and closer to getting your property. So we need to factor that in our return on investment, and we can do that with the following section. First of all, we need to separate the interest from the principal in our loan payments. To do that, we can use the cumulative interest payment function, which goes like this: CUMIPMT, open bracket. The first argument is the rate. We divide that by 12 again. Number of periods, 300. Then we got starting the present value, which is the mortgage value. The start period, which is we start from the first period. The end period would be the last period, 300. And the type, to be consistent, we'll use 1 as we did at the beginning of each period. And that way we get the entire interest amount that we have paid to the bank throughout the whole period. So in order to do that into a yearly interest payment, we have to just divide by 25, and we will get for each year you'll be paying around 4,961 dirhams in interest. Now, can we do that in principle? Yes, we can. It's a very similar calculation or a similar function. We just copy this and then paste. We'll change the cumulative IPMT into cumulative principal, PRINC. Using the same argument, we will get the annual principal payment. So this is every year you're paying 11,840 into your principal. The annual debt service or the annual loan payment equals the sum of the above. The sum of both, which is 16,801, which is exactly the same as what we have calculated earlier. Next, we just need to calculate the annual cash flow, including the principal payments. So the annual cash flow, which we have already calculated, was 1,150. Then we add the principal pay down. In this case, because it was already in minus, we have to, now it's a positive number, because we need to factor it in as a positive thing. Now we add them up, alt equal, we get 12,990. Now we need to calculate the ROI return, including the principal payment, invested equity, which we've already calculated up there. It is 117,700. The ROI return will be equal the annual cash flow divided by the invested equity, giving us 11%. Well, that sounds better. That sounds like a pretty sound investment to me. Now, you're gonna ask me, Zaid, what if we paid for the whole thing in cash? Can we do that calculation? Yes, we can. I've included that here in this bottom section. First of all, we go with the total investment capital, which equals the total investment we've mentioned here, and then the net yearly revenue, which equals the yearly revenue minus the yearly expenses. But in this case, because it's negative, we're going to go for plus. We get this figure. The cash ROI will be equals the net yearly revenue divided by the total investment capital. Now we get 4.34% if you had paid for the whole amount in cash. Now that sounds better than the cash flow that we're seeing up there, but not as the same as the ROI when we're factoring in the principal. I'm so glad we're done with that. So let's recap. What did we learn? Number one, the usual method of calculating the ROI doesn't really suit the mortgage purchases. Therefore, we have to resort to this template in order to have a more accurate idea or calculation of our return on investment. Number two, even when we are buying cash, you are still not accounting for all the costs incurred at the beginning of the investment and throughout the investment itself, like the yearly expenses. With this calculator, we are able to have a more accurate perspective or picture towards the investment that we can, or that you as an investor can see, or we as agents can give to our investors. Number three, even though your cash on cash flow might seem dim or might seem so very low, in this case it was 1%, that doesn't mean that you are losing or you're not gaining out of this. Keep in mind that you are buying property, you are gaining equity. By that, it is not considered as a loss, it is considered as a gain. Number four, would you go for a mortgage purchase or a cash purchase? Well, that all depends on your capital. If you can afford to pay for cash, eventually you would have less liabilities and you would avoid paying the interest. But if you, on the other hand, even if you can afford the entire amount, why would you want to freeze all of your capital into the investment instead of using that number or that amount of money or that cash into other fields, such as either another investment or your running business, and that will generate even more income that would cover that amount of interest. And finally, number five, this template and this example was based on a property that we had. Of course, for your own calculation and your own investment, feel free to tweak around with this template that would suit your investments more. If you've liked this video or you found this Excel template helpful, please feel free to comment in the comment below. And even if you have any suggestions to improve it, or if you didn't like it, again, comment below. And please don't forget to subscribe and hit that like button as usual. And as always, till the next time, keep investing.